There are many definitions of financial stability. And according to Ben Bernanke and economist Mark Gertler, financial stability depended on the net worth positions of potential borrowers. When we say net worth, these are uh, the value of all assets or the wealth of a potential borrower, such as house, uh, the value of their cars, jewelry, or cash in bank, minus the debt obligations that they have. And if that net worth positions of that potential borrower were low enough, there could be collapse in investment and thus economic activity. So they said that uh, we say that there is a financial stability if the net worth positions of potential borrowers is higher, uh, or it's high enough, then uh, the investment and the economic activity will be also stabilized. And another from Oriol Aspects, Charles Goodhart, Miguel Segoviano, Demetrios Somokos, and Leia Zikino, they said that credit risk is the central to financial stability, and thus low probability of default by borrowers is a key metric for financial stability. So when we say credit risk, this risk is the possibility of a loss resulting from a borrower's failure to repay a loan or meet contractual obligations. So they said that credit risk is the central to financial stability. So it's like the core of financial stability. And if there is a low probability of default, or we say failure to fulfill an obligation, if there is a low chance to commit that credit risk by a borrower, then there is it is a key metric for financial stability. It is an indicator that there is a financial stability. Another definition of financial stability from Charles Goodhart, he said that if everyone always fully paid their debts with certainty, there would be no credit risk, probably no money, and no need for financial intermediaries. So he said that if everyone can pay their debt obligations with certainty or without any disturbances, then there will be no credit risk, or there will be no chance of failure from paying a loan. So maybe there's no need for a financial intermediaries, or uh, there will be no need for a investment bank or commercial bank. Another from Claudio Borio and Matthias Dreman, they said that financial stability is the converse of financial instability, which occurs when a set of conditions is sufficient to result in the emergence of financial distress or crisis in response to normal cease shocks. So they said that financial stability is the opposite of financial instability, because when we say financial instability, this is when a condition is um, sufficient, or the emergence, or say the existence of a financial crisis. No. And then another definition from Gary Skenazy. There are three definitions of financial stability here. First one is that uh, financial stability facilitate both the efficient allocation of economic resources and the effectiveness of other economic processes. So it facilitates both efficient allocation of economic resources. When we say efficient allocation of economic resources, is that um, it's where the economic resources are being allocated efficiently or effectively. Like for example, the economic resources. These are land, labor, capital, entrepreneurship. So if these economic resources are being allocated or being distributed efficiently among buyers in an economy, then we say that there is a financial stability. Second is assess, price, allocate, and manage financial risk. So when we say that there is a financial stability is when we were able to manage the financial risk, the possibility of losing money on an investment, then there is really a financial stability. Then third is to maintain its ability to perform this key function primarily through self-correcting mechanism. So when we say ability of financial stability, this is to facilitate, to manage risk and absorb shocks. When we say shocks, these are negative disturbances that originate from financial sector. So if uh, if these functions or this ability has been maintained through self-correcting mechanism, then there is financial stability. Let's define first what is a self-correcting mechanism. It says that there is a flexibility of wages and resources prices. So flexibility of wages, it's like if uh, if the economic is high, then the wages are also high. Then if the economic is low, then the wages are also low. So that is the flexibility. So next is a practical analytical framework here. The macroeconomy, the financial institutions, and financial markets. So these elements are being interrelated of a central bank. So first, macroeconomy is free of major financial imbalances. Second, financial institutions, which are sound and stable. And then third is financial markets, which is smoothly functioning. So I'm gonna skip this slide because later on we're gonna dig deeper into this topic. So there are three reasons why macroeconomy, financial institution, and financial markets are said to be interrelated, or we say there is an interrelationship. So first one is to help disentangle the inherent complexity of the interrelationships into more tractable and manageable parts, because the relationships between these three is very difficult, and uh, so it will help to be more manageable. So second is corresponds well with the institutional setup of most modern central banks, even those without supervisory functions. So uh, the interrelationship of these three elements will uh, correspond well, or it will um, it will align to the institutional setup of the central banks, even there is no a supervisory function. Third is corresponds well to the disparate body of theoretical and empirical research on the issues related to financial stability. So with this three element, it will help to connect to the theoretical and empirical research. This is very complex issue which is related to financial stability. So, the inherent interrelationships between the macroeconomy, financial institutions, and financial markets will be uh, discussed furthermore on this slide. So, this is what the interrelationship of the three elements look like. So, as we can see here, the circles, there are three circles, and there is an overlapping dimensions of financial institution and the uh, macroeconomy and the financial markets. So on these overlapping dimensions, this is the areas of concern for financial stability, or so the the stable payments that are happening here will help to stitch the three elements seamlessly together. So on this overlapping dimensions, these are where the payments are made and there is a stable payment happening. So the inherent relationships between macroeconomy, financial institutions, and financial markets. Macroeconomy is a prerequisite and it must be free from major financial imbalances. When we say major financial imbalances, these are um, the household, uh, households, firms, and government, and they must be free from excessive indebtedness. So, because if these major financial imbalances are free, uh, there will be a sound and stable, or financial markets will continue to function smoothly. The counter effect of this is if the macroeconomy is not free from a major financial imbalances, then debts cannot be repaid in full, and so lenders or the financial institutions and savers in the economy would bear financial losses because their borrower cannot are failed to repay their loans. So the lenders and savers will really bear financial losses. And if that financial losses are large enough, then financial intermediation process in the macroeconomy would be at risk, and that will be the central bank would be at risk. And another counter effect of that is that the depositors could rush in to withdraw their money, while creditors of the financial institutions might call in their loans, which results to disruptions in investment, and consumption could ensue uh, because the macroeconomy is really um, hit by that major imbalances. And then next is troubles among financial institutions could freeze lending in the money and also usher in panics in other financial markets. Because financial institutions are um, experiencing crisis in that situation, so they're gonna freeze their lending, and the panics in the financial markets will arise, which result to the unstable of the financial system. When there is panic in the financial markets, it will bring a negative feedback loop to financial institutions and the macroeconomy. So the negative disturbances will flow from financial institutions to macroeconomy and then vice versa. And then, firms that rely on financial markets might find themselves short of funds during that difficult time, while households could be hit both with income and financial losses, dampening their demand for goods and services. And then there will be a severe financial instability, which would affect the economic activity, and then it will threaten the price stability of the economy. So if there is a financial issues, there must be measures to take, and one of it is to identify the issue and then group that issue into three separate groups accordingly, if that is macroeconomy or financial institution or financial markets. And if we are able to identify this issue, then we can create an effective solution through coordination using the informations and tools that we have gathered from the different units of the central bank.
Financial stability and organization of central banks. Financial stability is a condition in which an economy's mechanisms for pricing, allocating, and managing financial risks like credit, liquidity, counterparty, market are functioning well enough to contribute to the performance of the economy. Pricing is a process whereby a business sets the price at which it will sell its products and services, and it is a part of business marketing plan. And allocating is a process whereby a financial institutions allocate funds to those banks who are financially unstable. The central bank's main functions are to set the base rate, control the money supply through open market operations, set private banks' reserve requirements, and control the nation's foreign exchange reserves. The main objectives of the central bank is to maintain price and economic stability. Function of central banks. Most central banks already have a unit to monitor, assess, and forecast inflation and output in the macroeconomy. The central banks can easily leverage the existing capability of such a monetary policy unit of these central banks to monitor and assess risks to financial stability that might arise from financial markets. Financial risk refers to risk typically arises due to instabilities, losses in financial market, or movements in stock price, currencies, and interest rates. Central banks also interact actively with financial markets through their conduct of routine financial market operations. Financial markets. Financial markets are markets where market players with excess funds and market players in need of funds transact with each other. The term financial markets, in fact, is a generic term that encompasses a great variety of specific markets. Market players are those individuals who transact with each other within financial market, might include banks, non-banks financial institutions, and large and retail investors. Types of financial markets. Money markets for short-term lending. The money markets refer to the market for highly liquid, very safe, short-term debt securities. Second, capital markets for long-term funding, which include both equity and bond market. Capital markets are financial markets that bring buyers and sellers together to trade stocks, bonds, currencies, and other financial assets. Foreign exchange markets for foreign exchange funding. A market in which one currency is exchanged for another currency. For example, In the market for euros, the euro is being bought and sold, and is being paid for using another currency such as the yen, dinar, dollar, and peso. Derivatives markets. For hedging activities. Hedging activities means any forward sale, hedging or similar transaction involving any voting stock, including any transaction by which any economic risk and or reward or voting of ownership of or voting rights with respect to any such voting stock are transferred or affected. Central bank rules. Central bank with supervisory role can provide timely and detailed assessments on the banking sector's financial health. For central banks with a supervisory function, such as unit also often has experience and tools to influence banks on issues related to financial stability. Central banks without a banking supervisory often have a unit that monitors developments in financial institutions. Sectors governed by central bank. First, at the macroeconomy level. Key theories focus on interaction between financial activities of economic agents and their real economic activities. Second, with respect to financial institutions, relevant theories include models of bank runs, such as those pioneered by Douglas Diamond and Philip D. Brigg in 1983-19, which suggested that financial intermediation generally has a smooth functioning equilibrium, but is also inherently prone to instability. Third, with respect to financial markets, are theories relating to market failures based on information asymmetry with distorted risk-reward profiles. Investors and might accumulate excessive positions in certain financial assets. The macroeconomy, interaction between financial and economic cycle. The influence of financial activities like borrowing and lending on real economic activity with consumptions and investment has been recognized since at least the time of the Great Depressions or the economic breakdown or the country has suffering economically unstable. When I Irving Fisher argued that poorly performing financial markets contributed to the severity of the economic turndown. That's all. Thank you.
Economic agents work along the line of the research cited above by the Corley Show in 1995, Colonel Berker in 1978, Minsky in 1986, Bernanke and Jettler in 1990. Sila ang nag-point out na ang balance sheet or ang network positions of economic agents can influence direct spending and investment behavior and those business cycle. Sa kalig-on na posisyon sa network sa usa ka ahente magpasabot nga mas dako nga mga gamit alang sa paggasto ug alang sa usa ka kolateral sa paghulam. Ug kung ang ahente adunay bugat nga mga palas unang palabot sa network nga kantidad mahimong resulta sa una nga maghulam aron mapalit o mamuhunan sa mga kaptangan. Kung ang mga presyo sa asset nagtaas, nan ang pag-us-us sa mga presyo sa asset makapahuyang sa ilang balanse o makahatag sa ilang abilidad sa paggasto. Timai nga kung ang gipunduhan sa ahente nga pagpalit sa asset nga mga mas dako pinaagi sa paggamit sa hinulaman nga pundo, nan bisan nga gamay nga pagkunhod sa mga presyo sa asset mahimo makadaot sa ilang balanse. Financial instability in Minsky framework. The work of the late Hyman Pimensky was received much attention in the wake of the 2007 to 2010 crisis, partly because it aptly describes how the interaction between activities in the macroeconomy and financial activities can bring about financial instability. According to Pimensky, financing activities can be categorized into three distinct types. First, hence finance, second, speculative finance, and third, Ponzi finance. The easiest way to understand is to think of the typical mortgage. Hence finance means a normal capital repayment loan. Speculative finance is more akin to an interest-only loan. And then Ponzi finance is something behind even this.
It is like getting a mortgage, making no payments at all for the 5 years, and then hoping the value of the house has gone up enough that its sale can cover the initial loan and all the missed payments. You can say that the model is a pretty good description of the kind of lending that led to the financial crisis. Having introduced these categories, Minsky elaborates his financial instability hypothesis. The first part of the hypothesis is that if hence financing is the dominant financial posture of entities in the economy, then the economy is more stable. It can be shown that if hence financing dominates, then the economy may well be an equilibrium seeking and continuing system. In contrast, the greater the weight of speculative and the Ponzi finance, the greater the likelihood that the economy is a diversion applying system. The second theory of the financial instability hypothesis is that over periods of prolonged prosperity, the economy transits from financial relations that make an unstable financial system to financial relationships that make for an unstable system. And the prevalence of speculative and Ponzi financing relationships makes the economy unstable because numerous economic entities are now dependent on either selling assets or continually rolling over their debts in order to continue operating. Finally,
Of
with the previous
non-financial
crisis
assets.
is the
The
distance
research of
memory.
both Curley
We
and
reached the
Cho in
final
1955
stage Ponzi
and
finance.
Curly Burker
At this
in
point, banks
1978
makes
pointed
loans for
toward the
firms and
importance of
households that
non-money
can
financial
afford
assets,
to
that
pay
is,
neither
those
the
financial
interest nor the
securities issued by
principal.
the
Again,
intermediaries,
this
and
is
it can
underpinned by the
contribute to
belief
acceleration
that
and
asset
crashes
prices
in
will
economic
be
activity.
rise.
In the research, Curley and Shaw pointed out that if the central bank were to effectively maintain economic stability, there would be a need for financial control on the proliferation of non-money financial assets, in addition to monetary control or control of money. The role of non-money financial assets in a financial crisis has gained much attention in the wake of 2007 to 2010 crisis, although prior to that, mainstream research in macroeconomics has tended to neglect it.
Concept money versus non-money financial assets in macroeconomics. According to Gödel's 1988 work, the lack of emphasis on non-money financial assets and financial structures among mainstream macroeconomists was attributable to at least the three factors that follow. The influence of work by Franco Moldigirani and Merton Miller in 1958. Second, the publication of Milton Friedman and Anna Schwartz in 1963 book. Third, the popular use of reduced form econometric techniques, particularly vector autoregression. So, if it can be converted into cash easily, the asset is considered a monetary asset. Liquid assets are assets that can easily be converted into cash in a short amount of time. If it cannot be readily converted to cash or a cash equivalent in a short term, then it is considered a non-monetary asset. Non-monetary assets are not readily converted into a fixed amount of money in the short term. They include property, plant, and equipment. The behavior of financial intermediaries. So, financial intermediaries increase the efficiency of the allocation of capital and thus a positive impact on economic growth, while the link between financial intermediation and economic performance has been studied extensively in the literature. The factors contributing to a deeper intermediation have remained largely unstudied. The potential negative consequence of a lack of financial intermediation for investment and growth are the key factors underlying policy makers' increased interest in strengthening financial intermediation. Financial institutions, intermediation, bank runs, and banking system resiliency. In 1983, a study by Douglas Diamond and Philip Dybvig presented a model that formalized the act of financial intermediation and how financial intermediation might inherently be prone to instability in the form of bank runs. Financial instability reflects the ability of the financial system to consistently supply the credit, intermediation, and payment services that are needed in the real economy if it is to continue on this growth path. While financial instability occurs when problems or concerns about potential problems within institutions, markets, payment system, or the financial system in general significantly impair the supply of credit intermediation services so as to substantially impact the expected path of real activity. To summarize and perhaps simplify a bit further, my definition of financial instability has three key elements: problems in the financial system, impairment of intermediation or the supply of it, and a substantial impact on the real economy. Clearly, the central theme is financial or credit intermediation services, and they're supporting the real economy. Financial intermediation. According to Diamond and Dybvig, savers are reluctant to lend directly to businesses or households, since those loans are illiquid. By taking in funds from savers and promising that savers can withdraw their funds easily, banks are creating liquidity in the system. Banks then pool these funds together and lend them out to borrowers under long-term construct. By pooling deposits from a large number of depositors, a bank needs to keep only a small fraction of funds on hand to meet demand for withdrawals at any given point in time. The bank can then lend most of the rest of the funds out to its borrowers so that the funds can earn interest.
The Diamond-Dybvig model, the transmission from normal functioning to a bank run. So the Diamond-Dybvig is a model that influences model of banks that runs unrelated financial crisis. The model shows how banks mix up liquid assets such as business or mortgage loans and liquid liabilities. This deposit which may be withdrawn at any time may give rise to self-fulfilling panics among depositors. So if a bank's deposit a demand or if a bank depositor demand a withdrawal that are greater than the amount of the cash it has on hand, the bank could face major difficulties. A bank might simply run out of money and declare bankruptcy. After a bankruptcy, depositor would need to file legal claims to recover their money. The banking system as a network. A banking system is a group of a network of institutions that provide financial services for us. Those institutions are responsible for operating a payment system, providing loans, taking deposits, and helping with investments. For example, during a panic, once a troubled bank starts a fire sale of its short-term asset to raise funds, price of those assets could fall very sharply, causing losses in other banks' portfolio. Other banks might then be forced to have their own fire sales, which could affect everyone. Network resiliency and network fragility. Network resiliency and network fragility, according to Allen and Galley 2000, work in a better connected network. That is where the interbank market is completed, meaning that a bank of different types, example commercial bank, investment bank that focus on wholesale lending, and a banks that focus on attracting deposits from savers, are all connected to one another. Then potentially risks could be better distributed throughout the network. The proportion of the losses in one bank's portfolio can be shared by or more banks through interbank agreements. And in contrast, if the linkage between the banks in the network are incomplete, that is, a bank of different types are not well linked to one another in the interbank market, that failure of a bank of one type could potentially lead to a failure of a banks of the same type, then those of similar types, which could trigger the failure of the entire network.
Financial market. I discuss about financial markets. Reason for market failures. The belief that financial markets are, to a great extent, efficient lead regulators to take a more hands-off approach toward financial market regulation. With efficient financial markets, it was believed that market players would be able to make sound financial transactions based on their preference and their assessment of risk as reflected by marketplaces. There are some causes underlying market failures include negative externalities, incomplete information, concentrated market power, inefficiencies in production and allocation, and inequality. Inefficiencies in financial markets could manifest themselves in the behavior of financial markets and institutions, causing those inefficiencies to be significant factors contributing to aggregate economic activity. Adverse selection refers to situation in which inferior products, services, or clients are more likely to be selected because buyers and sellers do not have equal relevant information. This would deter safer borrowers from borrowing from the bank, since that rate would be too high to make the safer project profitable. Example of this: when sellers have information that buyers do not have, or vice versa, about some aspect of product quality, it is thus the tendency of those in dangerous jobs or high-risk lifestyles to purchase life or disability insurance when chances are getting they will collect on it. Next, owning to asymmetry information. Bank A cannot distinguish risky borrowers from safe borrowers, and thus charges a uniform 10.5% interest for all loans. The 10.5% rate is the average of break-even interest rates for those two types of customers. As safe borrower. Safe borrower invests in safer projects. Expected returns 10%. Probability of success 90%. Next is the principal agent problem. Refers to a situation in which a principal hires an agent does not have complete information as to whether the agent will act in the best interest of the principal or the best interest of the agent. Example is when an investor buys share of an index fund, he is the principal and the fund manager become his agent. The best way to solve the principal agent problem is to craft the right incentives for the agent, and this incentive should align with the incentives of the principal. The model of principal agent problem. Shareholders is the principal have a primary objective of long-term sustained increase in share value. The agent, management, and traders have an incentive to go for short-term profits, which sometimes could not at the expense of the long-term sustainability.
And the principal agent problem and the subprime mortgage lending. Example above, one can see the mortgage broker did not act in the best interest of mortgage lending. Mortgage broker were paid commissions by mortgage lending if they could get borrowers to sign up for mortgage loan. Here the mortgage broker and interest lend when the mortgage lender's interest. Mortgage broker meant interest was to sign up more and more borrowers so that they could get commissions from mortgage lenders. Mortgage lenders, so mortgage broker, and mortgage broker is prime safe borrowers and subprime risky borrowers. Mortgage lenders is lend to subprime borrowers, pay fees to broker. Then the mortgage broker is signed up subprime borrowers for complicated syndicated loan contract. Moral hazard. The 27 and 2010 crisis also highlighted the fact that investment bank compensation packages for manager and traders were another case of moral hazard problem. Since manager and traders' bonuses were often directly tied to profits, it's made sense for managers and traders to pursue strategies that were likely to generate the most profit. Even if the strategies were extremely risky, the events before the financial crisis revealed that if the risky strategy that they pursue succeed, managers and traders could make millions. Since the manager and traders were essentially using their people money, the bank balance sheet, and the pursuit of their strategy, the most they would lose. Implications of market failure for financial stability. As the preceding discussion have shown, problems such as adverse selection, moral hazard, or the principal agent problem can lead to bad outcomes in financial transactions. In the context of financial stability, it could thus be said that if the prices of financial assets do not reflect all known information, and such prices also might not accurately and reflect inherent financial assets, might be unknowingly holding assets that are inherently too risky for them. Think of banks owning bad mortgage loans or homeowner owning houses they can afford. For example, in some cases, buyers of financial assets could be just agents for the ultimate owners of those assets and could have misaligned interests with those owners. As players in the financial system accumulate their own ownership of mispriced assets, their financial position can become extremely shaky without them realizing it. Taking an aggregate of risky financial position of individual players becomes a big enough problem. It could become systemic risk and the threat to the financial system. To deal with information asymmetry and the financial stability context, hence, and these three broad issues must be addressed. First, transparency and financial information. Second, the financial literacy of population. And the third, alignment of incentives to correct for potential principal agents problem. Case study, information asymmetry and lead up to the 27-2010 crisis. As the 27 and 2010 crisis unfolded, it became clear the prices at which financial transactions had been done in lead up to the crisis were not based on full information. Information asymmetry was present at various levels of financial transaction, from simple subprime mortgage lending to sophisticated derivative trading. In many ways, it could be argued the pervasiveness of information asymmetry in various pockets of the economy helped contribute to the emergence of the crisis. Adverse selection. An example of diverse selection in the context of the global financial crisis is subprime mortgage lending. In the United States, the term subprime is often used for those borrowers who do not have good credit history or have low debt repayment ability, and requires found that prior to the crisis, in the order to earn more brokerage fees from mortgage lenders, mortgage broker had willfully disregarded subprime borrowers' ability to pay, in many cases requiring no proof of income or assets from borrowers. In turn were provided to mortgage loans, whose terms were very disadvantageous to them and were not easy to understand. In this subprime mortgage lending situation, bad mortgage loans were selected for borrowers who had the least ability to pay. The ultimate outcomes was that, as subprime borrowers started defaulting on their mortgage lenders took large losses and many went bankrupt.